You've probably heard about this trending financial news, but here's the quiet reality nobody is telling you.
Yeah, it's the part they leave out of the headlines.
Exactly.
Yeah.
So last year, like an employee at a multinational firm in Hong Kong authorized a $25 million transfer on a video call.
25 million.
Right, $25 million. And they saw their boss's face. They heard their boss's familiar voice, the exact cadence of their speech, even the usual background of their office.
It just looked completely normal.
Completely normal.
Huh.
It was a standard authorization process, the kind that happens, well, 1,000 times a day in corporate finance.
Sure.
But every single executive on that call, other than the victim, was a synthetic AI hallucination. The money was wired out and just vanished into a labyrinth of decentralized accounts.
It's terrifying.
It really is. And today, that exact same technology isn't just targeting megacorporations. It has trickled down. It is writing the personal finance articles you read over coffee this morning.
Absolutely it is.
It's generating the investment advice you see trending on your feeds. And it is comprehensively optimizing itself to extract money from your attention. You are navigating a system optimized to extract your wealth, and your financial decisions are basically just collateral damage.
Yeah, the whole paradigm of fraud has completely shifted.
Right.
We are no longer dealing with the clumsy phishing emails of the early internet, the prince who needs you to wire him $1,000.
Right, those were easy to spot.
Exactly. Now we are dealing with weaponized sense-making. The Financial Conduct Authority, in their 2026 Horizon Scan, they actually call this cognitive warfare.
Cognitive warfare.
Yeah. The threat isn't that you're going to buy a fake physical asset. The real threat is that the very logical processes you use to decide, what is true, what is a sound investment, and who is a legitimate fiduciary, well, those processes are being actively hijacked.
Hijacked by algorithms.
Algorithms operating at a scale that human beings just cannot intuitively comprehend.
Which brings us to the core mission of this deep dive today. We are basically tearing down the illusion of this pristine digital financial ecosystem.
We have to.
Right. We're pulling critical intelligence from investigative reports by Data and Society, the Financial Conduct Authority's strategic warnings, and cutting-edge cybersecurity research on multilingual AI detection.
And we're pairing all that with some timeless psychological frameworks from some of history's most legendary outsider investors.
Exactly. Our goal here is to equip you, the listener, with the cognitive lattice work necessary to protect your family wealth and your multi-generational trusts from this next generation of algorithmic deception.
It's about defense.
It is. But before we get into the actual mechanics of how this fraud operates, we have to lay down our standard ground rules.
An obligatory disclaimer.
You know it. Disclaimer. This is not investment advice. Always do your own research and consult qualified financial advisors before investing.
Very important.
Okay, let's unpack this. Because to understand the sheer scale of the extraction happening right now, we have to look under the hood of what cybersecurity experts are calling synthetic insecurity.
Right, synthetic insecurity. And that term is highly specific because the insecurity isn't like a bug in the code.
It's not a glitch.
No, it is a feature of the synthetic environment itself. I mean, the AI systems generating financial content today, they aren't merely regurgitating scraped text anymore.
So what are they doing?
They are engineered to simulate human reasoning patterns. They generate statements with incredibly tight internal logic, mimicking rigorous analytical frameworks.
Even when the data is fake.
Exactly. Even when the underlying data points are entirely fabricated.
Okay, let me stop you there. Because I have a hard time believing the entire internet is just, quietly accepting this.
Well, they are.
But if these AI systems are just making up data points, why aren't the underlying foundation models fixing it? The massive large language models built by trillion-dollar tech companies, they have armies of engineers and essentially infinite compute power.
It comes down to a systemic compounding architectural flaw. It's known as model collapse.
Model collapse. Okay, explain that.
So, when the first generation of large language models was trained, they ingested a relatively pristine diet of human-created content. They read books written by real economists.
Real human journalism.
Right, journalism from actual reporters, debates from human financial analysts. They learned to mimic that human structure.
Okay, that makes sense.
But once those models were released, they were immediately weaponized by malicious operators to pump out millions of synthetic financial articles.
Oh, I see. Which means the internet is now just flooded with AI-generated text.
Flooded to the point of absolute saturation.
Huh.
So when the next generation of AI models needs training data, what do you think they're scraping?
They're scraping the AI articles.
Exactly. They are scraping the synthetic output of the previous generation. They are basically eating their own exhaust.
Eating their own exhaust. Wow.
And this is where the math gets terrifying. AI models, They don't have an innate understanding of truth. They operate on probabilistic token prediction.
Right. They're just guessing the next word.
Exactly. So if a first-generation AI makes a slight hallucination, say, misinterpreting a nuanced tax law regarding index funds from 2020, it publishes that slight error.
Okay.
Then the next model scrapes that error, assumes it is consensus because it appears on thousands of automatically generated blogs, and then it states it as absolute, unquestionable fact.
So it's not just a photocopy of a photocopy where the image just gets blurry.
No, not at all.
The AI actually fills in the blurry spots with its own confident hallucinations.
Yes. The errors don't fade, they crystallize.
That is wild. So a completely hallucinated piece of financial advice becomes corrupted consensus simply by sheer volume. I mean, if I'm looking at a forum right now about, say, municipal bond yields, I might actually be reading the compounded hallucinations of an AI from 3 years ago, just echoing in an algorithmic chamber.
That is the exact mechanism. And you assume it is verified fact because, well, the grammar is flawless and the tone is super authoritative.
Right. It sounds like an expert wrote it.
But the delivery of this corrupted consensus is not random. It's highly targeted through a practice known as parasite SEO.
Parasite SEO. Okay. Search engine optimization has been completely co-opted.
Entirely.
But again, I have to push back here. Google's algorithm is arguably the most sophisticated sorting mechanism in human history.
It is.
So are you saying Google cannot tell the difference between a fiduciary with 2 decades of wealth management experience and like an automated content farm operating out of a basement with a $49 monthly AI subscription?
It's tricky.
Or is it that they just won't stop it because engagement drives their ad revenue?
Well, it is a combination of an economic disincentive, sure, but there's also a genuine technical arms race that the search engines are currently losing.
Really? They're losing.
Yeah. Google's algorithm fundamentally relies on proxy metrics for trust. It looks for fast loading times, specific keyword density, mobile optimization.
Structural stuff.
Right. Structural elements like headers and bulleted lists, and most importantly, authoritative backlinks.
Okay. Links from trusted sites.
Exactly. Now, AI agents can generate that structural perfection instantly. The bullet points, the mobile optimization, done in a second.
But they can't fake the backlinks, can they?
That's where the parasite aspect comes in. To get those authoritative backlinks, the operators use a highly specific strategy.
Take me through that. How does the parasite mechanism actually work? How does an operator hijack that algorithmic trust?
Well, the operators monitor domain auction sites. They are looking for expired website domains that have spent a decade or more building up a high domain authority score.
Like an old blog or something?
Yeah, imagine a retired university economics professor who let his personal blog's domain registration lapse. Or maybe a local community bank that was acquired and they just abandoned their old website.
Oh, wow.
The operator buys that expired domain for a few $1,000s. And instantly, they inherit a decade of algorithmic credibility.
Because the algorithm still remembers it as a trusted site.
Right. They inherit legacy backlinks from universities and news outlets and an immaculate trust score.
And then they unleash the AI agents on that domain.
Exactly. Over a single weekend, the operator sets their AI to scrape high-intent financial search terms.
Like what?
Things like Best Roth IRA Providers 2026 or Highest Yield Savings Accounts.
The high-value stuff.
Very high value. The AI generates hundreds of long-form, perfectly optimized articles targeting those exact phrases.
And because the domain has that high authority,
Google's algorithm immediately indexes the new content and pushes it right to page 1.
man, I see the trap. The user searches for legitimate financial advice. They click the top result because they trust the search engine's ranking, and they land on this beautifully formatted article.
Yep, it looks perfect.
But what is the actual monetization loop here? Why go through all this trouble just to trick Google?
Affiliate arbitrage.
Affiliate arbitrage.
The AI isn't programmed to recommend the best financial product for the consumer. It is programmed to recommend the product that pays the operator the highest affiliate commission per click.
Or per account opening.
Exactly. The operator is intercepting massive volumes of high-intent traffic and redirecting it to the highest bidder.
Completely disregarding fiduciary duty.
Or the actual quality of the financial vehicle, yes. They can capture tens of thousands of dollars in affiliate payouts before the search engine even realizes the domain has been compromised.
And once it's de-indexed.
By then, the operator has already moved on to the next hijacked domain. It's a churn and burn operation.
This just highlights how vulnerable retail investors are right now.
Yeah.
But here's where it gets really interesting, because the institutional side isn't immune either, right?
Not at all.
The manipulation isn't just happening on personal finance blogs, it's happening in corporate finance,
Yeah.
deeply embedded in the regulatory filings themselves.
Yeah, this is where we cross into the territory of adversarial machine learning.
Okay, let's get into this.
Institutions, banks, and regulatory bodies rely on incredibly complex mathematical models to detect corporate fraud in financial statements. Specifically, those 10K filings that public companies submit.
Because human auditors couldn't possibly catch everything.
Right. Historically, humans miss things, so we built algorithms to act as tripwires.
Like those famous mathematical fraud detection models that look for accounting anomalies, the ones that flagged companies like Enron way back before they collapsed.
Exactly. Those foundational models evaluate specific financial ratios to identify statistical anomalies that suggest earnings manipulation. They look at metrics like the day's sales and receivables index, the gross margin index, asset quality, things like that.
So if a company is aggressively recognizing revenue before it's actually earned, or hiding debt,
The ratios skew, the algorithmic score spikes, and it flags the company for an auditor review.
so how does adversarial machine learning break a mathematical model that is specifically designed to catch fraud? I mean, the math is the math, right?
The math is the math, yes, but AI can calculate gradients across multiple variables simultaneously in a way that humans just cannot.
Okay, explain that.
Well, a bad actor within a corporation, like a corrupt CFO, for example, can run generative adversarial networks, or GANs, against the fraud detection model itself.
So they use AI to fight the auditor's AI.
Yes. They essentially use an AI to simulate millions of variations of their financial statements. They do this to figure out exactly how to subtly alter specific variables to evade detection.
Give me a concrete example of how that balance works on a spreadsheet, like visually.
Okay, let's say the company wants to fraudulently inflate their net income to hit quarterly guidance and trigger executive bonuses.
Okay, classic fraud.
Right. If they just invent revenue out of thin air, that receivables index will spike, and the fraud model catches them instantly. They know the algorithm is watching that specific ratio.
So what does the adversarial AI do?
It calculates a counter move. It
Yeah.
suggests adjusting the cost of goods sold the COGS downward to boost the gross margin. But manipulating COGS impacts the inventory valuation.
Because the balance sheet must fundamentally balance. You can't just change one thing.
Exactly. Because it has to balance, the AI calculates the exact micro adjustments needed across both the COGS column and the inventory column.
Wait, so the AI is perfectly balancing the lie.
Yes.
It calculates the exact mathematical counterweight required to keep the fraud invisible to the algorithmic security guards.
Precisely. By subtly distributing the fraudulent numbers across multiple interdependent variables, those specific AI-calculated tweaks cancel out the red flags the detection model is looking for.
That is terrifying.
Recent cybersecurity research demonstrates that by utilizing these adversarial attacks, a corporation could theoretically inflate their stated earnings by 100 to 200%.
Wow.
And while doing that, magically reduce their algorithmic fraud detection score by 15%.
How do they look safer?
Yes. They appear statistically healthier to the fraud model precisely because they are utilizing an advanced mathematical deception.
Okay, I'm struggling to understand why the defensive AI, like the models used by the auditors and the institutional analysts, can't catch this.
It's a huge blind spot.
We keep hearing about these multimodal large language models that can pass the bar exam, right?
Yeah.
They can write complex code.
Right.
You're telling me they can't read a 10K and spot the discrepancy between the stated text and the manipulated tables?
This is a critical vulnerability that is actively being exploited right now. The current generation of LLMs fails spectacularly at what researchers call multilingual financial misinformation detection, or MFMD.
Multilingual. Why does the language translation aspect matter if we were just talking about parsing numerical tables?
Because of how LLMs process information at a foundational level, they do not read text and they do not calculate math.
They just predict tokens.
Exactly. They process data into tokens. So when an LLM is trained on a massive global data set, it ingests financial documents in English, Mandarin, Spanish, German, and so on.
Right.
The tokenization of financial jargon across different languages is highly inconsistent. A term like working capital deficit in English might map to entirely different token structures when translated from a regulatory filing in Tokyo or Frankfurt.
Oh, I see.
Furthermore, the formatting of tables, like whether a culture uses commas or decimals to denote thousands, or how currency symbols are aligned, that fractures the semantic meaning for the AI.
So the AI gets confused by the formatting and the cross-lingual data. But how does that stop it from doing basic accounting?
Because, again, an LLM does not possess an internal calculator.
It's just a language engine.
Right. When researchers tested these advanced models against complex financial documents, the AI consistently failed at basic numerical reasoning and table parsing.
How bad was the failure?
Well, if a company's text narrative claims, "We achieved a 38% increase in gross margin," the LLM reads the text, associates the token 38% with positive performance, and just accepts it.
It doesn't check the math.
No, it does not go down to the data table, extract the raw revenue numbers, subtract the cost of goods sold, divide by the revenue, and verify if the math actually equals 38%.
It just accepts the stated percentage in the text blindly.
The AI acts as an incredibly articulate, highly confident, but mathematically hollow rubber stamp.
Which means the auditors who are relying on AI to summarize these 10K filings are actually inheriting the adversarial manipulation without even realizing it.
Yes, the entire institutional ecosystem is essentially operating on corrupted data.
Okay, so if we map out this entire scam ecosystem, from the parasite SEO farms to the adversarial corporate filings, we have to ask the fundamental question.
Who wins and who loses?
Exactly. Who are the winners and who are the losers in this new economy?
Well, the underground economy of synthetic deception is highly structured. The primary winners at the retail level are the operators.
Those are the individuals sniping the expired domains.
Right, running those affiliate arbitrage loops we discussed earlier. But as we scale up, the real winners are transnational criminal organizations, or TCOs.
We hear the term TCO thrown around a lot in cybersecurity briefings, but what does the architecture of a modern scam syndicate actually look like?
They operate with the efficiency of multinational tech conglomerates. They are primarily based in massive guarded compounds in Southeast Asia.
Like physical compounds.
Oh, yes. They have dedicated departments, software engineers writing the AI scraping tools, psychological profiling teams developing the scripts to manipulate victims,
Wow.
and money laundering divisions utilizing decentralized cryptocurrency mixers to hide the stolen funds. The scale is industrial.
And we can't ignore the systemic complicity of the platforms themselves, right?
Not at all.
The search engines and the social media networks inadvertently win here.
Because of engagement.
Yes. Because this massive influx of synthetic engagement, the millions of AI articles, the automated bot comments agreeing with the articles, the time users spend scrolling through manufactured debate, it drives their core metric.
Time on site.
Exactly, which directly translates to ad revenue.
Yeah.
The platforms actually have a perverse incentive to let the synthetic ecosystem flourish.
Because it inflates their numbers. And the clear, unequivocal losers are retail investors. The cost of this deception is not theoretical.
No, it's not.
It's not just about accidentally downloading a bad app. It is about the systemic, invisible extraction of wealth over time.
I want to make this incredibly tangible for the listener. Let's look at the actual math of how this synthetic deception drains your portfolio.
Okay, let's do it.
Let's say you are looking to park some cash. You search for a safe yield. You click on a parasite SEO article that appears totally authoritative.
Because it's on a trusted domain.
Right. And it tells you, with complete confidence and beautifully generated charts, to put your money into a specific high-yield savings account. It highlights a 0.5% yield, and the AI-generated text describes it as highly competitive for the current macroeconomic environment.
Which is a complete fabrication.
Entirely.
Driven solely by the fact that this specific account pays the operator a $150 referral bounty.
Exactly. At that exact same moment, real FDIC-insured institutions are offering 5% yields.
But the 5% bank isn't paying the scammer a commission.
So the AI completely omits it from the consensus. If you put 10,000 USD into the scammer's recommended account, you're missing out on 4.5% in interest.
That's 450 USD a year.
$450 a year, invisibly stolen from your potential returns.
And 450 bucks might not sound catastrophic in isolation, but that ignores the most powerful force in finance.
Compound interest.
Yes. If you make a wrong decision on a retirement fund allocation based on manipulated AI content in your 20s or 30s, say you get pushed into a fund with a 1.5% expense ratio instead of a 0.05% index fund.
Just because the AI article was optimized to sell the high-fee product.
Exactly. You aren't just losing a few $100s. Over a 30-year compounding timeline, that single synthetically induced bad decision can cost you tens of thousands of dollars in lost growth.
We are talking about 45,000 USD, 80,000 USD or more.
And completely erased from your net worth. and you will never receive an invoice for the theft.
You simply arrive at retirement significantly poorer.
Which perfectly transitions into a vital perspective we need to consider here.
What's that?
We are facing an unprecedented technological landscape, but the human brain navigating it hasn't received a hardware update in roughly 200,000 years.
That is a great point. The algorithms are new, but the vulnerabilities are ancient.
Exactly.
This brings us to a crucial perspective. Let's look at what historians say about this kind of deception. It proves that while the tools of extraction have evolved, human behavioral flaws remain exactly the same.
The mechanics of these AI scams rely entirely on exploiting known cognitive biases. We're talking about greed, fear, loss aversion.
And authority bias.
Yes, perhaps most importantly in the context of synthetic media, authority bias, and social proof.
Like if an interface looks clean, if the typography mimics a trusted financial institution, we just trust it.
Right. If there are embedded charts and quotes from supposed experts, our brain utilizes a heuristic shortcut. We assume the high production value equates to factual accuracy.
We see the cleanly formatted web page, the blue verification check marks, the professional headshots, and we drop our guard.
It's the digital equivalent of a con artist wearing a tailored suit.
Exactly. And this is where we must apply the frameworks of some legendary outsider investors, those who spent their lives analyzing how human misjudgment leads to catastrophic financial errors.
Right. There's a brilliant term coined by one of these billionaire investors for what happens when these psychological flaws compound. He called it the lollapalooza effect.
The lollapalooza effect.
Yes, this occurs when multiple cognitive biases operate in the same direction at the same time, leading to an extreme irrational outcome.
So it's not just one bias at work.
No, it is not an additive effect where one bias plus one bias equals 2. It is an exponential effect where 1 plus 1 equals 11.
Okay, so how does the lollapalooza effect specifically map onto the current crisis of AI-generated financial misinformation?
Look at the anatomy of a modern crypto or high-yield scam. First, you have the massive technological hype surrounding AI and decentralized finance.
Which triggers authority bias because people assume the tech is too complex to question.
Exactly. Second, you have confirmation bias. Investors actively searching for information that validates their desire to achieve outsized returns quickly.
They want it to be true.
They do. And third, you inject a massive dose of deprival superreaction syndrome, which most people just call FOMO, the fear of missing out.
Ah, right. The AI article includes a countdown timer or limited allocation warning.
Exactly.
So the AI is simultaneously telling you that the experts agree. That's authority. It's confirming your hope that you can beat the market confirmation. And it's threatening that if you don't act now, you'll lose the opportunity forever FOMO.
Yes. When those biases align, the Lollapalooza effect takes over. The rational prefrontal cortex shuts down, and the investor wires the money.
Wow.
The scammers engineer their synthetic content specifically to trigger this exact cascade of psychological failures.
It's weaponized psychology. And, if we zoom out and look at this through the lens of economic history, the exploitation of information asymmetry has always been the primary weapon of financial predators.
Oh, absolutely.
Yeah.
Where one party knows significantly more than the other.
Think about the bucket shops of the 1920s. The operators had the ticker tape. The retail speculators on the floor were operating on delayed, manipulated information.
The operator knew the real price, and they took the other side of the sucker's bet.
Right. Or the local snake oil salesman in the 19th century.
Yeah.
He knew his tonic was just water and pepper, but the townsfolk didn't have the pharmacological knowledge to dispute his claims.
The fundamental difference today is that AI has industrialized that information asymmetry to a degree that was previously unimaginable.
We are dealing with snake oil factories operating at the speed of light.
Generating bespoke, personalized deception tailored to your specific search history and psychological profile.
To truly understand how sophisticated this has become, we need to examine how these concepts manifest in reality.
We need to look at specific case studies of synthetic deception in action.
Let's dissect the ETF trap. We touched on the lost yield of savings accounts earlier, but the way AI is manipulating investment vehicles is terrifyingly subtle.
Walk us through a scenario.
Okay, consider this. A retail investor trying to responsibly manage their portfolio searches for the best ETFs for long-term growth 2026.
Okay.
They bypass the sponsored ads and click the first organic search result, trusting the search engine's ranking. They land on an immaculate website.
Describe the visual layout of this synthetic trap. Why does it work?
It leverages every trust signal we've been conditioned to look for. The color palette is deep blue and white, colors associated with legacy banking.
Very corporate.
Exactly. There are interactive JavaScript charts showing hypothetical compound growth. There are embedded quotes from a senior portfolio strategist detailing the macroeconomic headwinds.
It sounds totally legitimate.
There's a detailed methodology section explaining how the ETFs were selected. The user is literally hovering their finger over their brokerage app, about to allocate 8,000 USD based on this specific analysis.
But the reality behind the interface is entirely hollow.
Entirely. When cybersecurity researchers reverse engineered this specific page, they found that the highly recommended exchange-traded fund had actually been liquidated and shut down by the issuer 7 months prior.
It didn't even exist anymore.
It no longer existed. The senior portfolio strategist was an AI-generated headshot. The author's website domain had been registered exactly 2 weeks prior.
No regulatory disclosures, no verifiable human identities.
None. Just incredibly confident language and tracking links embedded in every single paragraph, waiting to capture a referral fee if the user clicked through to the underlying brokerage.
And millions of people search these terms every month. They are being funneled right into these automated, highly polished traps.
What is most dangerous here is the AI's ability to perfectly mimic the epistemology of finance.
Epistemology, meaning how we know what we know?
Right. In finance, we know things are credible through charts, citations, and expert consensus. The AI understands these proxy signals.
It knows you want a chart to feel secure, so it generates a chart based on hallucinated data.
It knows you trust authoritative quotes, so it fabricates a quote that perfectly aligns with your confirmation bias.
Which brings us to an even more insidious form of manipulation. It's one thing to fake a chart. It's another to fake a human being's core philosophy.
Oh, this is the deep fake billionaire ideology.
Yes, let's look at this case study. There was a viral video recently that swept across every major social platform. It featured one of the most legendary, famously successful billionaire investors in modern history.
The pioneer of value investing.
Exactly. A man known globally for his deep understanding of rational capital allocation. But in this video, he is looking directly into the camera, claiming that owning a home is a scam and that he rented his primary residence for his entire 30-year career to maximize his liquidity.
And the engagement on that video was massive. People were sharing it everywhere, using it to justify their own financial decisions, saying, look, the richest investors in the world don't even buy real estate.
But the video was entirely AI-generated.
Completely fake.
There was no original interview, no transcript exists in any verified archive, no timestamp from a real financial news network.
It was a complete synthetic fabrication, but the deepfake was flawless. The cadence of his voice, the slight gravel in his throat, the specific micro-expressions he uses when he makes a profound point.
Even the lighting of the room, it was seamless.
This highlights a profound danger that goes far beyond a simple scam. The AI isn't just getting a few numbers wrong on a spreadsheet.
No, it is actively rewriting financial history and personal ideology to push internet myths.
This legendary investor built his entire legacy on the philosophy of margin of safety and minimizing irrational decisions.
But the AI completely erased his actual nuanced philosophy and replaced it with a highly viral, controversial clickbait slogan, always rent, never buy.
It's ideological identity theft. They're stealing the immense, multi-decade trust this individual built and weaponizing it to push a narrative.
And who benefits? Maybe a private equity firm trying to normalize a renter-centric economy, or maybe just an operator trying to farm engagement and ad revenue on a controversial topic.
The motive almost doesn't matter. The destruction of truth is the same.
Exactly. And when this technology moves from manipulating retail sentiment to actively attacking corporate infrastructure, the financial losses scale exponentially.
Which brings us back to the multi-million-dollar synthetic heist in Hong Kong that we talked about at the very beginning.
We need to look at the mechanics of that.
Right. The 25 million USD transfer. How does a corporation with rigid internal controls, compliance officers, and authorization protocols fall for an AI hallucination?
By exploiting the very communication infrastructure we normalized over the last few years, the employee in the finance department received an email requesting a massive, confidential transaction.
Naturally, the employee was suspicious.
And the scammers anticipated this friction, so they proposed a video conference call with multiple senior executives to provide verbal authorization.
Which seems like the ultimate verification. If I can see the CFO and the CEO on the screen and they tell me to wire the funds, I'm going to wire the funds.
Exactly. The employee logged into the call. They saw the faces of the executives they knew. They heard their voices providing the specific account details and authorizing the release of funds.
So the employee initiated the $25 million transfer.
It was only later, when the employee casually mentioned the transfer to the actual executives, that the horrifying reality set in.
Every single executive on that video call was a real-time deepfake.
The technical execution of that is staggering. They had to clone the voices and render the video in real time, responding dynamically to the employees' questions.
Where do they even get the data to train the AI to do that?
The scammers utilized publicly available audio, earnings calls, media interviews, keynote speeches. They used that to train the generative AI models to perfectly mimic the executives.
This is the reality of the threat landscape. The biometric verification we use to rely on our eyes and our ears has been completely compromised.
It has. And the geopolitical reality behind these operations is grim. The Department of Justice recently launched a scam center strike force to battle what are essentially massive, militarized criminal compounds in Southeast Asia.
This isn't a couple of hackers in a basement.
The scale of these transnational criminal organizations is difficult to comprehend. They operate out of highly fortified compounds.
And tragically, the people executing the scams on the keyboards are often victims of human trafficking.
Yes, held against their will and forced under threat of violence to run these operations around the clock.
They are running industrial-scale pig butchering scams.
It's a gruesome term for a highly sophisticated, psychologically devastating practice.
They target affluent individuals, often starting with something innocuous, right, like a wrong number text message.
Right. Hey, is this David? We're still on for golf tomorrow. You reply, sorry, wrong number. And the operator uses that tiny opening to strike up a conversation.
The long con begins.
They don't ask for money immediately. They spend weeks, sometimes months, building a relationship. They use AI to generate photos of a luxurious lifestyle.
They use language models to craft perfect, emotionally resonant responses, building a deep friendship or a romantic connection. They map the victim's psychological profile.
And once the trust is absolute, they casually introduce a financial extraction.
They mention how much money they're making trading a specific cryptocurrency or utilizing a novel yield farming strategy.
They offer to show the victim how to do it. They guide the victim to download a specific trading platform.
And the platform is, of course, a completely synthetic environment controlled by the syndicate.
Yes, the victim deposits a small amount of money. The interface shows massive immediate returns.
The victim is allowed to withdraw a small amount to prove the liquidity, which sets the hook.
Exactly. The victim then deposits their life savings. The numbers on the screen go up, but the actual funds have already been laundered through a crypto mixer.
And when the victim finally tries to withdraw their major balance,
They are hit with fake tax requirements or liquidity fees. Eventually, the platform vanishes and the friend disappears.
the DOJ reports that these syndicates are stealing billions of dollars annually, utilizing AI to scale their emotional manipulation across millions of targets simultaneously.
It's a massive wealth transfer.
Okay, we have covered a lot of incredibly dark territory here. The scale of the deception, the model collapse, the adversarial manipulation of corporate filings, the deepfake heists.
It's a lot to take in.
But the entire purpose of this deep dive is empowerment, not paralysis.
Absolutely.
We don't want you logging off the internet, liquidating your portfolio, and burying your cash in the backyard. The final phase of this discussion is about how we protect portfolios in the era of synthetic insecurity.
This is about strategic legacy protection. The question is, how do you build a proactive cognitive shield around yourself, your family wealth, and your multi-generational trusts to fend off this industrialized algorithmic fraud?
We have to bridge the gap between traditional asset protection, the legal and structural defenses of wealth, and a deep understanding of modern information warfare.
Right.
We are going to provide actionable takeaways, Wealthnetic style, that you can implement immediately to filter the noise and protect your capital. Let's dive into the defensive frameworks.
Let's do it.
Tip number 1, employ inversion as your timeless psychological defense.
This is where we return to those legendary investors who championed the mathematical concept of inversion as a primary tool for rational thinking.
They frequently quoted a famous mathematician who said, invert, always invert.
Yes. Human nature dictates that when we approach an investment or a piece of financial advice, we operate from a forward-looking, optimistic bias.
We ask, how can I succeed with this? How much money can I make if this goes right?
But that is the exact mindset that leaves you vulnerable to the lollapalooza effect. You must flip the script. You must ask, what would kill this idea? How can I fail?
By focusing on the negatives first, you instantly short-circuit your own confirmation bias and FOMO. So here is the practical Wealthnetic twist for you, the listener. Whenever you are reading financial advice online, watching a beautifully produced video about a new asset class, or scrolling through a seemingly organic forum discussion,
You must ask the ultimate inversion question.
who benefits if I follow this advice? And what is the exact mechanism of their compensation?
You must trace the incentive structure. If an article is aggressively pushing a specific trading platform, a high-yield crypto staking protocol, or a specific credit card, you must look for the disclosure.
And if you cannot easily find a clear, prominent affiliate disclosure explaining their exact financial relationship with the product, you need to close the tab immediately.
The friction of finding their conflict of interest shouldn't be high.
Exactly. If the incentive structure is hidden, assume the content is a synthetic trap designed to harvest a commission off your capital.
This leads directly to our next defensive posture. Tip number 2. Demand primary sources and seek visible friction.
Explain visible friction.
Well, you can no longer rely on the convenience of AI aggregators or perfectly formatted SEO blogs to summarize the health of an asset. You must bypass the synthetic intermediaries entirely.
If you want to know about a public company's health, do not read a blog post summarizing their quarterly earnings.
Go to the regulatory database. Pull the actual 10K and 10Q filings. Read the primary documents.
Though, as we discussed with the vulnerabilities of adversarial machine learning, even the numbers within those filings can be manipulated.
True. You cannot just accept the stated text. You must scrutinize the raw tables and apply your own critical analysis. But beyond corporate filings, the concept of visible friction is crucial when evaluating community consensus.
Think about real human interaction. Real human communities are inherently messy.
We argue. We have different risk tolerances, different tax situations, different investment horizons.
Right. If you go onto a financial forum, like a specific thread on a social site, which we know is currently being inundated by automated bot networks, and the conversation feels too smooth, you should be terrified.
Define what you mean by too smooth in a community context.
I mean a scenario where a user posts, "I just inherited 50,000 USD, how should I allocate it?" And instantly, within minutes, there are 30 replies.
And every single reply is perfectly formatted, grammatically flawless.
And they completely agree that the user must use this specific robo-advisor app and enter this specific promotional code. There's no debate.
No one asking clarifying questions.
Exactly. There's no user saying, "Wait, what's your marginal tax rate?" Or "Do you have any high-interest debt you need to clear first?"
The complete lack of friction, the immediate uniform consensus toward a specific actionable product is a massive red flag.
Real human financial advice is full of friction, caveats, and disagreement. If the consensus is perfectly uniform, apply extreme skepticism.
It is highly likely that the entire thread is a manufactured consensus generated at scale by an AI bot network executing a parasite SEO strategy.
That is a phenomenal heuristic for navigating social finance. Which brings us to tip number 3. Rigorously verify human credentials and fiduciary duty.
In the era of synthetic insecurity, an author bio at the bottom of an article that says senior financial analyst or wealth enthusiast is absolutely meaningless.
An AI can generate a professional headshot and a compelling backstory in milliseconds.
Even a comprehensive professional profile, complete with endorsements and work history, can be entirely fabricated.
So how do we verify who is real and who is a synthetic entity designed to drain our accounts?
You must verify their credentials using official, immutable databases. You need a verifiable regulatory record that ties a human being to a legal entity.
But beyond merely checking if they exist, you must actively seek out a true fiduciary.
This is arguably the most important distinction in all of personal finance. A fiduciary is not just a financial professional. They are someone legally mandated, under penalty of law, to act in your absolute best financial interests.
They are fundamentally different from a broker or a salesperson who is only bound by a suitability standard.
Right. Which means a broker can sell you an expensive, high-fee mutual fund with a massive front-end load, as long as it isn't technically unsuitable for your age.
Fiduciaries charge a flat fee for their time, or a transparent percentage of assets under management. Their legal and financial loyalty is aligned entirely with you.
The instinct for many investors is to avoid paying for advice when free advice is abundant online.
But paying a verified fiduciary for 2 hours of their time to rigorously review your retirement allocation and ensure your multi-generational trust is structured correctly might cost you a few $100s.
That cost is exponentially cheaper than the 80,000 USD you could lose over a 30-year timeline by following unvetted AI-hallucinated advice designed to extract affiliate commissions.
You must invest in verifiable human accountability. The cost of human friction is the price of security. And finally, tip number 4. Build a latticework of mental models.
This is the ultimate overarching defense mechanism.
You must stop relying on single data points, viral sound bites, or isolated metrics.
To truly navigate an environment where the information itself is adversarial, you need to combine knowledge from multiple disciplines to form a robust cognitive defense.
You need an understanding of psychology to recognize when your own FOMO and susceptibility to social proof are being triggered by an interface.
You need a foundational grasp of basic mathematics to understand the brutal, unforgiving reality of compound interest interest, expense ratio degradation, and regression to the mean.
And you need basic engineering principles. You need to understand the concept of building a margin of safety into your portfolio.
Right. You design a bridge to hold 3 times the maximum expected weight so that if a stress test fails, the bridge doesn't collapse.
You must build your portfolio the same way, diversifying across non-correlated asset classes so that if an AI-generated flash crash wipes out a specific sector, you don't lose your entire net worth.
True financial success is a grueling, often boring process. It takes immense time and discipline.
You must avoid the traps of closet indexing, where high-priced active managers charge you exorbitant fees, but essentially just hug the index anyway. You are paying a premium for an illusion of expertise.
Avoid the noise of market fads. Focus entirely on rational, independent, multidisciplinary thinking.
If you construct that mental lattice work, the AI deepfakes, the synthetic consensus, and the algorithmic hype will simply bounce off your logic.
You won't be easily manipulated because your financial foundation is built on timeless, immutable principles, not the ephemeral, shifting sands of algorithmic manipulation.
So let's synthesize everything we've uncovered today. What is the core, inescapable message of this deep dive?
The internet is no longer a neutral information environment. The digital ecosystem you interact with daily is an industrialized machine, comprehensively optimized to extract your wealth through the manipulation of your attention and your trust.
The threat is not a hacker breaking into your bank account. The threat is an algorithm tricking you into happily wiring the money yourself.
But by bridging the gap between traditional asset protection and a rigorous understanding of modern information warfare, you can filter out the noise.
You can protect your legacy.
The tools of extraction have evolved, but your capacity for critical thought remains your most potent defense. It requires constant vigilance, but it is entirely within your control.
You simply have to slow down, invert the premise, demand visible friction, and apply unyielding critical thinking.
Absolutely.
If this deep dive opened your eyes to the reality of the synthetic financial landscape, I want to warmly invite you to subscribe to the Wealthnetic channel. We are committed to dismantling these complex threats and providing you with the intelligence needed to navigate them.
It's so important right now.
Share this conversation with a friend, a colleague, or a family member who might be vulnerable to these new scams. Because we all know someone who is a little too eager to trust a beautifully formatted chart or a viral video promising outsized returns.
And most importantly, take the time to explore the original source frameworks we discussed today.
Dive into the principles of inversion and the lollapalooza effect. Start building your own mental lattice work.
Before we sign off, I want to leave you with one final, deeply provocative scenario to mull over.
Oh, lay it on us.
We have spent this entire session analyzing model collapse, adversarial machine learning, and how the next generation of AI is currently training on today's corrupted, hallucinated financial consensus.
Building massive economic structures on a foundation of synthetic data.
Precisely. So I want you to ask yourself a terrifying question.
Okay.
What happens when the next global market panic is not triggered by bad mortgages or failing regional banks or a real-world supply chain collapse?
What triggers it then?
What happens when the next massive, catastrophic financial crisis is triggered entirely by an AI-generated hallucination? A synthetic, mathematically complex crisis that every high-frequency trading algorithm on Earth suddenly believes is completely real, and they all execute their sell orders simultaneously.
Wow. That diagnostic X-ray machine we rely on won't just be showing a murky picture. It might start showing us a catastrophic systemic fracture in the global financial system that doesn't even exist but causes a real-world depression anyway.
Exactly.
Stay sharp out there, build your lattice work, and keep questioning the diagnosis.